Investing can be a powerful tool for building wealth over the long term, but it's important to understand the risks and potential rewards involved. When investing, it's important to have a clear investment strategy and to select investments that align with your investment goals and risk tolerance. However, I can give you some tips on how to approach the process of selecting stocks for beginners. Do your research. Before investing in any stock, make sure you understand the company's business model, financials, management team, and growth prospects. This can be done by analyzing company reports, news articles, and other financial resources. Yes, doing research is an important step in the investment process. Researching a company's financials, management team, business model, growth prospects, and competitive landscape can help you make informed investment decisions. It's also important to stay up to date on the latest news and trends in the stock market and the economy as a whole. This can help you identify opportunities and risks in the market and adjust your investment strategy accordingly. There are many resources available to help you conduct research, such as financial news websites, stock market analysts, investment research firms, and company reports. It's important to use a variety of sources and to be critical of the information you receive, as not all sources are reliable or unbiased. Consider diversification. It's important to spread your investments across different stocks and sectors to reduce your risk exposure. This means investing in a variety of companies, not just one or two. Yes, diversification is an important aspect of investing. Diversification means spreading your investments across a variety of assets, such as stocks, bonds, commodities, and real estate, to reduce your overall risk exposure. In the context of investing in stocks, diversification means investing in a variety of companies across different sectors and industries. This can help you reduce the impact of a single stock or sector on your portfolio's performance. For example, if you only invest in technology stocks, your portfolio may be highly volatile and exposed to risks specific to the technology industry. However, if you diversify across multiple sectors, such as healthcare, consumer goods, and energy, you can reduce your overall risk exposure and potentially achieve more stable returns over the long term. It's important to note that diversification does not guarantee profits or protect against losses, but it can help you manage risk in your portfolio. Invest in what you know. It's easier to understand and analyze companies in industries that you're familiar with. Look for companies that you use or consume products from regularly. Yes, investing in what you know is a good strategy for beginners, as it allows you to understand the companies and industries you're investing in. By investing in companies whose products or services you're familiar with, you may be able to better assess their growth prospects, competitive advantages, and potential risks. For example, if you're an avid user of a particular tech company's products and services, you may have a better understanding of the company's user base, market position, and potential for growth. This knowledge can help you make more informed investment decisions and potentially achieve better returns over the long term. However, it's important to note that investing solely in what you know can lead to overconcentration in a particular sector or industry. Therefore, it's important to diversify your investments across different sectors and industries to reduce your risk exposure. Be patient. Investing in the stock market is a long-term game. Don't get caught up in short-term fluctuations and focus on the big picture. Yes, patience is an important trait for investors. Investing in the stock market is a long-term game, and it's important to have a long-term perspective when making investment decisions. The stock market can be volatile and unpredictable in the short term, but over the long term, it has historically provided strong returns for investors. One of the keys to successful investing is to avoid getting caught up in short-term fluctuations and to focus on the big picture. It's important to have a well-thought-out investment plan and to stick to it, even during periods of market turbulence. By having patience and discipline, you can avoid making impulsive investment decisions and potentially achieve better returns over the long term. However, it's also important to periodically review and adjust your investment strategy as needed. The stock market and the economy are constantly changing, and it's important to adapt to new circumstances and to rebalance your portfolio to reflect your changing investment goals and risk tolerance. Consider index funds. If you're unsure about picking individual stocks, consider investing in index funds that track the performance of a particular market index, such as the S&P 500. Yes, index funds can be a good investment option for beginners and seasoned investors alike. An index fund is a type of mutual fund or exchange-traded fund, ETF, that seeks to track the performance of a particular market index, such as the S&P 500. Investing in an index fund can provide a number of benefits, including diversification. An index fund typically invests in a broad range of stocks, which can help reduce your risk exposure compared to investing in a single stock or sector. Low cost. Index funds typically have lower fees compared to actively managed funds, which can help you save on investment costs over the long term. Low cost is an important consideration when investing, as investment fees can have a significant impact on your overall investment returns. When selecting an investment, it's important to pay attention to the fees and expenses associated with the investment, such as management fees, transaction fees, and other costs. One way to keep investment costs low is to invest in low-cost index funds or exchange-traded funds, ETFs. These funds are designed to track the performance of a particular market index and typically have lower fees compared to actively managed funds, which can help you save on investment costs over the long term. Another way to keep investment costs low is to avoid frequent trading and turnover in your portfolio, as this can lead to higher transaction costs and tax implications. Instead, consider a long-term investment strategy that emphasizes buying and holding a diversified portfolio of investments. It's important to remember that investment costs should not be the only factor you consider when selecting an investment. It's also important to consider other factors, such as the investment's historical performance, risk profile, and alignment with your investment goals and risk tolerance. Simplicity. Investing in an index fund is a straightforward process, as you don't need to select individual stocks or perform extensive research on companies. Simplicity is an important consideration when investing, especially for beginners. When selecting an investment, it's important to choose an investment that you can easily understand and that aligns with your investment goals and risk tolerance. One way to keep things simple is to invest in low-cost index funds or exchange-traded funds, ETFs. These funds are designed to track the performance of a particular market index and typically have a simple investment strategy that is easy to understand. Additionally, index funds can provide broad diversification, which can help simplify your investment portfolio. Another way to simplify your investment strategy is to focus on a few key investment principles, such as diversification, asset allocation, and long-term investing. By following these principles, you can build a simple, diversified portfolio that is designed to achieve your investment goals while managing risk. However, it's important to note that simplicity should not come at the expense of thorough research and due diligence. It's important to understand the investment you're considering and to make sure it aligns with your investment goals and risk tolerance. Additionally, it's important to periodically review and adjust your investment strategy as needed, based on changes in the market or in your personal circumstances. Historical performance. Over the long term, many index funds have provided strong returns that have outperformed the average actively managed fund. However, it's important to note that index funds are not without risks, and past performance is not a guarantee of future results. It's also important to select the right index fund for your investment goals and risk tolerance, as there are many different types of index funds that track different market indexes and have different investment strategies. It's a good idea to consult with a financial advisor or conduct your own research before investing in an index fund. Remember, investing always carries some level of risk, so it's important to consult a financial advisor or conduct your own research before making any investment decisions. That is it for today's video. Please comment down below with your insights and ideas. To learn more about business, life, and technology, subscribe to this channel, and we'll see you on our next video.